Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, July 13th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we got futures pretty strong. Dow futures up 76, S&P 500 futures up about 17, NASDAQ futures up 114. Crude oil prices relatively flat, still sitting just below $76 a barrel. And the U.S. 10-year Treasury yield down another 3 basis points, 3.83%. It was just up at about 4.10%, but recently we saw an island cluster reversal that I had pointed out. Did look like it was set for a reversal if we got the gap down. We did get the gap down, and we've been seeing the 10-year Treasury yield roll over. Looking more and more like a short term, maybe an intermediate term top. But we'll look at that chart in just a second. Earnings are starting to come out. We had Pepsi out this morning, Delta Airlines, and then we really get the kickoff with earnings season tomorrow. That is when we will see many of those large money central banks. JP Morgan will be out, Citigroup will be out, and a couple of other stocks, a couple other big names. Then next week, things will start to pick up. And then the following week is when we're really start to see a deluge of earnings. But the market continues to move higher. It continues to, what I think, price in a pretty good earnings season. And the ones we saw this morning, at least a couple of them that I saw this morning, certainly getting us off to that positive start. Today, what we're going to do, I'll give you a quick outline, go through, do the daily market recap, talking technically, chart of the day. Momentum sleeper, just a really quick look at a stock that's been consolidating for a while. We've seen a lot of stocks in this space breaking out. This one's been consolidating. I think it's poised for a breakout, starting to strengthen. We'll go over that during the momentum sleeper. And then earnings spotlight and the 3 you must see. So let's go ahead and get this thing started. And we'll start with the daily market recap. The Dow Jones Industrial Average finished up 86 yesterday. S&P 500 up 33. NASDAQ up 188. Mid caps up 19. Small caps up 13. So on a percentage basis, we saw the baton being passed over to the NASDAQ 100 again. So the NASDAQ showing some leadership. It is breaking out, as you can see right here, for a second time with that declining PPO. What I would be most concerned about is if we saw, say, a gap up in the morning and then a big sell-off during the day, some sort of a bearish engulfing candle, some kind of a negative candle, bearish candle with that negative divergence. That would be something that would maybe tell me, hey, just maybe be a little bit more cautious based on some of the signals that are out there. But otherwise, as I keep saying, this market wants to go higher. I believe we're heading for all-time highs later this year. And, what we saw yesterday, I think is just another step in that direction. Transports also up earlier in the day, did come back down and finish in negative territory, finishing down 25. That was kind of a little different twist. We've been seeing the transports leading the market. Yesterday, we saw a little bit of money rotating out of that group, which isn't all that surprising. I mean, my gosh, since the beginning of June, we had this group down around 13.6, and now we're up over 16,000, or yesterday, at least intraday, we went over 16,000. So that was getting close to 20% move in about 6 weeks. So transports deserve a little bit of break, and maybe we'll get a little bit of a move back in transports back down to test that rising 20-day moving average. Moving on to the sectors, we had utilities up about 1.5%, materials 1.3%, communication services 1.2%. So a little bit of a mixture there. We had our defensive group, utilities, what I consider our neutral groups, which are materials and energy. So we had one of those neutral groups, materials, and then one of the big aggressive groups, communication services, all three of them up there leading the move to the upside. I will mention technology was fourth, even though it's not shown here. So it was still, pretty much flavored towards some of those aggressive growth names. Gold miners and gold had a pretty good day yesterday. The DJ USPM rose almost 4.5%, 4.4%. Home builders up 2.87%, and internet up a little over 2%. I mentioned this one because internet is the group that has been consolidating. I've talked about it recently. When a group goes through this and it consolidates, a lot of times you can get stocks within the group at a little bit of a discount, or at least during a pullback. And so I wouldn't be surprised after an uptrend followed by sideways consolidation. I'm expecting that next move in internet stocks to be higher. Check out this PPO, which is now moving closer and closer to the zero line. All of that lines up for another advance in internet stocks, in my opinion. The 10-year Treasury yield, you can see this morning, let's see what we've got here. Yeah, this morning we're down 4 basis points, back down to just under 3.82%. It is significant, though. We're moving back below the 20-day moving average. At least we're opening there. We'll see where we close today. But if we do continue making this move to the downside, it would be a little bit different than what we've seen over the course of the last 2 months, as we've mostly trended above that 20-day moving average. There was that 410 area right there I talked about. There was the top. And then these are the 3 candles right here. The gap open up to 4%. Then we go to 410. We come back down, close near 4%. Those 3 candles sitting on an island together. So you get more than one. That's called an island cluster. And then you get the reversal on a gap down below the cluster. And that's what we saw 2 days ago. Now we've got yesterday and then also today, further downside. I had said back at the top, I could see a move back down to 370, which would be the recent lows. That would also be the 50-day moving average. We're getting there rather rapidly. From there, hard to say. I think with inflation expectations lowering, I really don't see the need right now to sell bonds unless you really believe the stock market, or not the stock market, but the economy is just ready to explode. We've already had the 10-year Treasury yield come up quite a bit off the lows. And if inflation is no longer a problem, I would think rates would start to come back down. But if the economy is strong enough, that would be something that could keep it up, and folks still selling bonds in order to move into equities. So I think there's been a character change on the chart. I've been talking about that recently. I don't believe that this is that the recent uptrend in the 10-year Treasury yield has been the result of increasing fears of inflation. I think if that were the case, we would see the stock market responding the way it did when yields were going up a year ago. And when that was happening, we saw those growth stocks, the aggressive growth names, the more offensive oriented stocks, those were all getting hit when yields were going up. February, when yields went up, we struggled in the market. Remember, we topped the beginning of February in the equity market, same time we bottomed in the bond market, or the 10-year Treasury market anyway. So right now, what I'm seeing is over the past couple months, we've seen the yield going up and the market going up with it. And that is more normal type behavior when the market is anticipating some additional economic strength ahead. And so that's what I'm expecting. That's what transports are telling me. During this run up, we've also seen transports going up, right? So I think it's more related to the economy than it is to inflation fears. And that's a completely different animal. And I've seen folks talking about, well, rates are going up. That means the stock market must go down. That's only if you have recency bias. That's only if you've been if you're only looking back at what happened in 2022, which was a completely different market. It was a cyclical bear market. So, and it was, one of the reasons, you can't really sit back and pinpoint exactly which reason was the most important, but one of the key reasons was the scare with inflation. And since that leveled off, you can see the 10-year Treasury yield has not broken out to a new high, but it's also not gone, moving back down. That's what I thought would happen. I thought once inflation fears, we started to roll over, I thought we'd see the 10-year Treasury yield come down with those lowered inflation expectations. And also thought the Fed would kind of, tap on the brakes a little bit, maybe more than tap on the brakes, maybe even put the car in reverse and start lowering rates. But they're seeing economic strength. And so that I think is playing into this anyway, as well. So anyway, I think that we're not in the same market we were a year ago. And that's why you're not seeing the same intermarket behavior. And it lines up. It lines up with the transports. It lines up with the small caps, areas that have started to make a move again. But anyway, that's just my thoughts on that subject. Moving on to talking technically, S&P 500 made another breakout. And by the way, yesterday we got as high as 44.88, almost to 4,500. I mean, if you're still clinging to a bear market theory, you're truly clinging. NASDAQ 100 making its move, closing to a new high above that 15,250 level. We hadn't seen that. With that move, you can see slightly higher highs, PPO coming down. We do have a negative divergence. 50-day test is possible in this environment. Cannot rule it out. That would catch a lot of folks by surprise, but that would be a potential, I'm going to say 900 to 1,000 point drop, which would be somewhere in the 6% range. I do think it's possible. And again, I don't like to bet against secular bull market advances, because what could happen is we could just keep going up and this PPO could turn back up and eventually just eliminate the negative divergence. So it's not a situation, we're not in a, I don't have the warning signs that I had a year and a half ago. If I had those and I was seeing this, yeah, there might be a chance I would short. In this market and with the signals I have, zero chance I'm shorting. The only thing I might consider is maybe, moving a little bit into cash, which I have not done at this point. Again, if I see a big reversing candle, gap up, sell off all day, that kind of thing, then maybe I would turn a little bit more defensive. Moving on, IWM, so the Russell 2000 small caps broke out on Tuesday. We gapped up yesterday, printed a black candle. That could be a short-term top. I don't really see any corroborating signs in terms of resistance, anything like that. So sometimes you get these black candles right in the middle, not usually after an uptrend. I mean, here you could see a little bit of one where we went up, we gapped up, printed a black candle, and then kept going higher. So these things are not guarantees, but you can see this one, when we moved up off an uptrend, we printed that black candle, went back down. But this happened right at a key resistance level. This one's just up in space. So I wouldn't be surprised to see the IWM just go right up through it. I think the odds favor the down move, but I think the market and all my other underlying signals suggest we're going higher. So I wouldn't rule out the IWM just continuing to push to the upside. Transports, nice move. This is what I've talked about with the 10-year Treasury yield going up. If it was going up because of inflation, we'd see a lot of the market being hit, stock market that is, being hit to the downside. We're not seeing that. So instead, I think rates are moving up more because of natural causes, which are, strengthening the economy. We've already seen a couple of earnings reports coming out pretty strong. I'll go over those in just a minute. But this is a big move up in the transports. I think this tells us the economy is strengthening or expected to strengthen. And that tells me that any move up in the 10-year Treasury yield has more to do with the economy than it does with inflation. And we just got the CPI report out yesterday, by the way, and CPI came in better than expected, lower than expected. The annual core rate now has dropped below 5%. We were, at 6%. Now we're heading back toward the Fed's 2% target. It's not going to happen overnight, but we are seeing inflation roll over, and I think that's a great sign for the equity market. All right. Let's keep moving here. I'm going to go into the chart of the day. If you want to receive a chart of the day, we're actually 3 a week, so every other day starting on Mondays. If you go over to earningsbeats.com, you can scroll down. We have a free Earnings Beats Digest newsletter. We'd love to have you join. Name and email address, that's all it takes. Hit that subscribe button. We'll have you set up. Like I said, it is reported or sent out Monday, Wednesday, and Friday, usually around 8:30 in the morning. So normally it's about an hour before the market opens. That's what we strive for anyway. No credit card required. You can unsubscribe anytime. We'd love to have you. All right. Let's go on to that chart of the day today, which I'm going to bring up RingCentral. This is a stock that was a high flyer a couple years ago. Hasn't been for the last 2 years, though. At least you can see over the last year, continually downtrending. Couple of head fakes to the upside here, but otherwise just downtrending. Seems like maybe we're making a little bit of move. I don't know if this is going to turn out to be similar to what we saw back here from November to February. But from a lower level, down around the 25 level, you can see it started with this gap up, big volume, filled the gap. We've continued to bounce off the 20, move higher. When we did pull back, we essentially just pulled back to the prior high. So from a technical perspective, this has been acting very bullish. And then after hitting support the last 5 days, look at all of these hollow candles, which results in the AD line soaring. This is, pretty nice action right now in the stock. I would just be careful if it falls back, say, below the 20-day. And if I were to get in, even at the current price, I would probably have a second entry down or closer to maybe 35 or so. Just in case we get that pullback. It's hard to chase these stocks and not at least leave a little bit of powder for a pullback. If it keeps going, great. You got half your position. So I always refer to this being half a genius. If it keeps going, the half you bought makes you pretty good money. If it pulls back, then you're able to get into that second entry. So again, being in not fulfilling out that position, and saving the other half, that was genius. So either way, you're half a genius. And probably makes sense with companies like this that are gapping up and just taking off rather than chasing them after 5 days. Stock was at 31 and change. Now it's at 38 and change. That's after 5 days. So could it go to 40, 45 and keep rolling? Sure. I do think overhead resistance, you've got gap resistance going to come in probably at about 41 and a half. And then the top of that gap resistance is all the way up closer to 50 at about 48 and change. So those are the two levels to watch to the upside. All right, momentum sleeper. I just wanted to point out Shopify. I mean, look at the volume that came in on this push to the upside. And this came after an already extended uptrend. So this stock had moved from a low of 24 in October to a high of 65 in early May. And so I think what we've seen is just a little bit of sideways consolidation. But look at that first 50-day test since back in mid-April, 3 months. As soon as we hit it, look at the 2 or 3 beautiful days, candles. Look at yesterday, volume picking up. A breakout above 67.5 would be bullish here. All right, earnings spotlight. Let's go through and talk a little bit about some of the earnings that have come out. So Pepsi came out this morning. They beat $2.09 versus $1.95. And I don't know if you saw the article I wrote just a couple of days ago, but I talked about how there's the manipulation around earnings season, where Wall Street tends to buy the stocks heading into earnings. It's called buy on rumor. I've heard it before. And then you see a sell-off sometimes after earnings. Well, Pepsi didn't exactly do that because we had the big run-up heading into May, and we've kind of just been going sideways after a pullback. So Pepsi hasn't really done that, but a lot of stocks do. And what happens is, what I see almost every quarter is folks saying, analysts coming on saying, well, we don't think earnings season is going to be that good this year. We see a lot of misses and disappointments. I showed in my article, over 80% this century, about 80% or more companies beat their earnings expectations. 80%. That's kind of like the average. 4 out of 5 companies. You've heard that, what is that ad that comes out about 4 out of 5 dentists, support this or whatever. Well, 4 out of 5 companies will report better than expected earnings. That's been the history, according to Yardeni research, which is where I got the information from. So, I mean, I see it all the time. So I don't know. I would have probably guessed 70 to 80% beat. So 80% doesn't surprise me. That's kind of in the ballpark of what I was expecting. But when you hear these analysts coming on to these various media outlets, CNBC and the like, and they start talking about, oh, this is going to be a rough earnings season, just remember what I'm talking about here and what Yardeni research has put together. 80% of companies beat. Pepsi beat 209 versus 195. And as far as the reaction goes, up $4.38. So pretty nice move on Pepsi this morning. How about Delta Airlines? I mean, if you've been watching these airlines, they have literally, no pun intended, taken off. The last 2 months, straight up, not just on Delta, but a lot of these names. But as you can see down below, Delta relative to the airline index has been strong. This has been one of the bigger names, one of the better names. And so I like to look at this because this could be like the poster child for airlines earnings. I mean, this is the one that has been built up the most based on relative strength heading into earnings. So what did Delta do? Well, they were expected to earn $2.42. And I think I wrote about this in the EB Digest or whatever, maybe a week or two ago, or maybe it was in an article. Maybe it was in the Daily Market Report. I write so much, I don't know where it was. But I said I'd be shocked if Delta Airlines didn't beat its earnings estimate. 242 was the estimate. They came in today at 268, more than 10% higher than expected. And I forget the quote that the Delta Airlines CEO said this morning, but essentially it was, hey, we're getting a whole new gang of customers that are really, liking us. It's like, we got our cult following. I'm paraphrasing, but that's what he had to say. And this is what the chart tells us when we see this and we see the relative strength. You don't usually see this kind of behavior in the market and then hear the CEO come out and say, we had a bad quarter and we don't like what we see ahead. That rarely happens. And if it does, then, the Wall Street folks have been, bamboozled. Maybe that's the right word. And they don't like that. They don't like buying a stock going into its results because they believe things are improving. And then the CEO comes out and pulls the carpet out from under them. They don't like it. Anyway, Delta came through. They had a great pre-earnings run up and they're getting, they got the numbers they were looking for. Now, I would be careful after this gap up today, simply because we've run so much in this group. A short-term pullback wouldn't surprise me. So if we go up here, I don't know what it's doing right now in pre-market, but we're going to find out together. Up $1.80, almost 4%, 49.75, a new high. I would be tempted to take the, news and maybe sell at least a portion of my Delta if I owned any. I don't own any. Wish I did. But I would maybe take something off the table because it could be a buy on rumor, sell on news kind of a thing. Get this gap up and then start to see some sellers coming in taking some profits. So just be careful with that one. Let's see. Fastenal matched estimates at 52 cents. So this one had been going up. They just matched. I would expect that unless they raised forecasts, which I haven't seen, I would think maybe Fastenal would be down. And yeah, it is down. Just a little disappointment there. Let's see. Conagra Brands, 62 cents versus 60. And this is part of the food group, which has not been very strong. And you can see Conagra has not been very good. They beat, and the stock, there's just no love for the group right now, which again is why relative strength is so important. You need to know where the money's going. If you're a momentum trader and you're trying to trade stocks in groups that are downtrending and the stock's downtrending, if you're trying to trade it on the long side, I wish you the best. Really hard to do. Maybe with this earnings report and the fact that we've been going down, maybe this gap down, or maybe the fact that we've made this move and now the earnings are out, maybe we'll see a little relief rally for a buck or two in the stock, but I wouldn't really expect a whole lot more. I'm gonna go into the three you must see. I'm gonna start off with let's start off with Domino's. Now, this is a black candle that I would at least take notice of. Big move up, huge gap up, failure to sustain it. Look at the high at 410, right at a key resistance level where we had that double top almost a year ago. So I definitely could see 410 being a very difficult area for Domino's to get through. And I wouldn't be surprised if we went back down and filled the gap. We'll see. Again, I don't like the short. So for me, it would only be a situation that maybe I would sell the stock if I owned it. Or if I wanted to get into it, I would wait and either see that breakout or allow it to come back to me. All right. Next is Enphase. Enphase, you can see making a move. Talked about renewable energy and how it likes the month of July. Well, here comes Enphase after putting in almost a double bottom there. Seems to be on course to maybe test this 188 area. If we can break above that, I think Enphase could have some area to run. And then the last one I have for you today is NEM. Excuse me. This is Newmont Corporation. And I'll put it on a relative chart for you so you can see it's part of that mining area. And it's actually started to strengthen versus the group. And this was a group I told you at the beginning of the show had a really nice day yesterday. And look at who was leading it. Newmont Mining gaining 4.4%. I think this is a stock that has room to the upside, maybe into the upper 40s to low 50s. It's been beaten down for a while. To the downside, just be careful if it goes back down below both moving averages. All right, that's it for me. I appreciate you tuning in. I'll be back next Tuesday, actually next Monday, for your next Trading Places Live. That will be over at earningsbeats.com. If you want to join me, when you go over to Earnings Beats, right around 9 o'clock, just simply click on this Trading Places Live link. And right now, when the video goes live, all you have to do is just click play. So anytime right at about that 9 o'clock time frame on Monday, you can join me for the next Trading Places Live. So have a great rest of your day, rest of your week and weekend, and enjoy this bull market. It just keeps marching on. Happy trading, everybody.